Imagine having a financial advisor who never sleeps, who analyzes millions of data points simultaneously, who never makes emotional decisions, and who continuously learns from every market movement. This advisor would identify investment opportunities that traditional managers miss and adjust your portfolio automatically when conditions change. This is not imagination anymore. This is the reality of artificial intelligence driven smart investing in 2025. Artificial intelligence is creating a new era of investment management where sophisticated strategies previously available only to the ultra wealthy are now accessible to ordinary investors at a fraction of the cost. According to Mercer's 2024 AI and Investment Management Global Manager Survey, 91% of asset managers either currently use AI, which is 54%, or plan to use it within their investment strategy or asset class research, which is 37%. This represents near universal adoption among professional investors. A 2024 survey by Deloitte reported that over 65% of asset managers had integrated AI into their investment processes, up from 45% in 2021. The speed of this transition from skepticism to mainstream adoption has been remarkable. The global market of AI for asset management was valued at $84.85 billion in 2024 and is projected to grow from $107.7 billion in 2025 to $1,168.33 billion by 2035, exhibiting at a compound annual growth rate of 26.92%. This explosive growth trajectory reflects something fundamental. The investment management industry is undergoing a complete restructuring around artificial intelligence technology. The three superpowers AI brings to smart investing. The first superpower artificial intelligence brings to investment management is the ability to analyze complexity at scales that no human could ever achieve. Portfolio managers using artificial intelligence tools to build baskets around investment themes, such as a class of weight loss pharmaceuticals, can uncover a wide breadth of positive and negative exposures in just a matter of minutes using the large language model's deep knowledge base supplemented with text analysis across conference calls. What previously required weeks of research can now be completed in minutes. The second superpower is real-time optimization. Traditionally, portfolio rebalancing was a periodic task done monthly or quarterly. Today, AI allows for dynamic, real-time rebalancing based on individual risk profiles and market movements. Rather than waiting for a scheduled review, artificial intelligence systems monitor portfolios continuously and adjust instantly when conditions warrant rebalancing. The third superpower is personalization at scale. In 2025, investors expect their portfolios to reflect not only their financial goals, but also their values such as environmental, social, and governance preferences, and AI enables hyper-personalization by analyzing a client's risk tolerance, life goals, and market behavior, then adjusting the portfolio accordingly. This level of customization, delivered to millions of investors simultaneously, is only possible through artificial intelligence. The BlackRock revolution? BlackRock demonstrated how portfolio managers using artificial intelligence tools can identify the less obvious leg of a thematic trade with minimal human intervention needed, while portfolio manager expertise remains ingrained in every part of the process, from defining the specific theme, customizing the analysis with human-determined assumptions, iterating on the output with full transparency into the large language model's logic, and refining the insights expressed in portfolios. This hybrid approach represents the most effective model emerging artificial intelligence doing the computational heavy lifting while humans apply strategic judgment. BlackRock found that there are scenarios where portfolio manager input is crucial for correcting a mistake the large language model has made or providing more context to improve the quality of the output. Democratizing institutional strategies, digital platforms including robotic advisors, smartphone banking applications, and online trading platforms have democratized financial services by giving regular people access to resources previously available only to large investors. With these platforms utilizing advanced algorithms to automate trading, optimize portfolio management, and provide personalized financial advice, all while reducing transaction costs and enhancing market participation. Firms like Wealthfront and Betterment have popularized robo-advisory models that use algorithms to rebalance automatically and tax efficiently, especially for retail investors. These platforms have fundamentally changed the economics of investment management, Where a traditional advisor might charge 1% annually, robo-advisors charge 0.25% or less. This cost difference compounds dramatically over decades of investing. When machines beat humans, artificial intelligence, powered investment risk analytics help reduce portfolio volatility by 20%. This is not a marginal improvement. A portfolio that would decline by 50% during market crashes instead declines by 40% over long time periods. This risk reduction difference translates to dramatically higher retirement wealth, eliminating up to 50% of manual investor prospecting and onboarding tasks improves investment managers' productivity by more than 14%. Organizations applying AI in wealth management can expect an 8% or higher rise in assets under management and over 7% growth in revenue due to enhanced advisor capacity and sharper financial planning. JP Morgan's artificial intelligence engine LOXM executes trades with minimal market impact by learning how other traders react, significantly improving execution quality for large orders, which helps fund managers preserve value for investors. This is not just cost savings, this is performance. When you execute large trades with less market impact, you preserve returns for clients. One of the critical barriers to AI adoption in investment management has been the black box problem, systems that make good predictions but cannot explain why. A report by the World Economic Forum in 2024 highlighted the need for explainable AI in financial decision making to maintain trust and compliance. For meticulous, heavily regulated industries like wealth management, data scientists create explainable artificial intelligence models where AI's prediction and prescription logic is fully transparent and easy to interpret for asset owners, advisors, and regulators. This transparency transforms artificial intelligence from a tool that generates returns mysteriously to one that provides defensible rationale for every investment decision. According to Gartner, 33% of enterprise software applications will include agentic AI by 2028, up from less than 1% in 2024, with at least 15% of day-to-day work decisions being made autonomously through artificial intelligence agents. This represents a fundamental shift in how organizations make decisions by leveraging the combination of large language models, retrieval augmented generation, and advanced vector search. Artificial intelligence agents are enabled to analyze vast financial data sets, detect patterns, and adapt in real time to changing conditions dynamically. With this advanced intelligence elevating decision, making and empowering portfolio managers to enhance portfolio performance, manage market risks more effectively, and perform precise asset impact analysis. Despite the impressive capabilities, artificial intelligence in investment management faces genuine limitations. Some artificial intelligence models, particularly deep learning, operate as black boxes, with managers potentially not fully understanding how predictions are made, and poor or biased data can lead to flawed decisions, no matter how powerful the artificial intelligence. Over-reliance on artificial intelligence as a replacement for strategic thinking or human oversight is a dangerous trap, and as artificial intelligence adoption grows, regulators are raising questions about fairness, bias, and systemic risk. Matthew Leiberg, Global Head of Artificial Intelligence and Asset Management for Manulife Wealth and Asset Management, describes artificial intelligence as an accelerator, not an autonomous decision maker, and when interpretive diversity narrows, whether through uniform regulation or algorithmic similarity, systemic fragility increases. Machines and humans in partnership, the market for artificial intelligence asset management is set for a massive $17 billion in value by 2030, with this growth showing that companies are no longer debating whether to use artificial intelligence, but are focused on how to use it right now. The clear winner emerging is the hybrid model where artificial intelligence handles computational tasks and humans handle strategic judgment. The revolution in artificial intelligence portfolio management is just getting started, with emerging trends including reinforcement algorithms that adapt to changing conditions and discover novel strategies, advanced natural language processing that understands complex financial documents like humans do, federated learning that lets institutions collaborate on artificial intelligence development while protecting sensitive data, and Internet of Things data analytics that provides real-time economic insights. The new era of smart investing belongs to investors and institutions that most effectively combine artificial intelligence sophistication with human judgment. Artificial intelligence will continue to transform the investment process, with models growing more sophisticated, data growing more granular, and execution growing faster. But markets are not science fiction. They run on incentives, institutions, and risk taking, and those roads are built by people. The democratization of investment genius through artificial intelligence is reshaping global finance. Ordinary investors now have access to strategies that rival hedge funds. Emerging market investors have access to tools that previously only the ultra wealthy could afford. The playing field is becoming more level, driven not by regulation but by the fundamental economics of artificial intelligence. The cost to serve one client is nearly identical to serving millions. Smart investing in 2025 is not about beating the market through superior intelligence or insider information. It is about aligning yourself with artificial intelligence systems that process information faster, see patterns more clearly, and adapt more quickly than human traders ever could. The investors who embrace this shift will build wealth in ways that would have been impossible just 5 years ago.